Hi, this is Elliot Eisenberg, consulting economist to American Pacific Mortgage, catching you up to date on the latest in economics. And since the start of 2022, I think two major events have taken place. First, interest rates have risen considerably. They've declined a little bit of late, and we'll talk about that, but they've jumped quite a lot. The 10-year treasuries jumped a bunch, 30-year mortgages have jumped higher, and they happened really right after the new year started. And what drove this is the question. And the answer is inflation expectations. Prior to the new year, there was belief that pent-up demand was kind of ending, that supply chains were kind of going to get fixed, and that the labor market was going to get better, but it wasn't going to happen fast because employment improvements seemed to be occurring slowly. So all of this didn't put a lot of pressure on inflation. But then everything changed in a heartbeat. The employment data was very strong. Revisions to prior months drove the unemployment rate very far down quickly, much faster than anticipated. Supply chain problems got worse, arguably, and consumer demand for stuff remained incredibly strong, in part because of Omicron. So as a result, the Fed changed its tune, and suddenly it said, man, maybe we're not going to raise rates 3 or 4 times. Maybe we'll raise them as much as 6 or 7 times. We'll see. When that occurred, when that sea change of viewpoint of the Fed changed, suddenly long-term rates jumped right up. 10-year treasuries went up and mortgages went up. The second thing that's occurred is the Russian invasion of Ukraine. And that's caused 3 things to happen. The first thing is that inflation's going to get worse, there's no question, because energy prices and generally commodity prices, things like nickel, palladium, platinum, corn, wheat, and so on are getting more expensive. Secondly, as a result, GDP is going to be pushed down. Those two cause the Fed to act in opposite directions. Inflation says we better raise rates more, but GDP says, slowing down, but we better slow down on rates. So they probably cancel each other out. And the third and most important thing for housing is there's a flight to quality. People think, oh my God, the Russians are going to bomb a nuclear reactor and Europe's going to go toxic. We better buy something safe. Treasuries, they do that, and interest rates begin to decline, and that's what we've seen. In the short run, this is unambiguously good for housing and refi activity. However, in the long run, I don't think this persists. The war kind of goes into the background. We understand the phenomena better as it plays itself out, and I think the Fed returns to its normal plan of 5 or 6 rate hikes. So enjoy the short run, and think of it this way. Right now, there are 11 million available jobs and only 6 million unemployed Americans. If the Fed raises rates and that 11 million falls to, say, 7 million, that's okay. So the economy can certainly withstand some higher interest rates as they occur throughout the year. Enjoy the short run, but expect the Fed to pretty much stay on its long run path. That's it for now. I look forward to seeing you next month.